Hey everyone, welcome back to the channel. If you're a fan of personal finance or have ever read Rich Dad Poor Dad by Robert Kiyosaki, you know how impactful this book can be. Today, we're going to break down one of the key concepts from the book, understanding income, expenses, assets, and liabilities, and why this is crucial to your financial future. Whether you're just getting started on your financial journey or you're looking to refine your knowledge, this video will help you see these fundamental concepts in a new light. In Rich Dad Poor Dad, Robert Kiyosaki introduces a simple but powerful concept, understanding the difference between assets and liabilities. And it's not just about knowing the definitions, it's about how they affect your financial position and overall wealth-building strategy. So, let's break it down. What is an asset? An asset is a resource owned by an individual or entity that retains or grows its value and is expected to provide future economic benefits. In Rich Dad Poor Dad, Kiyosaki defines assets as something that puts money in your pocket. And what is a liability? A liability is an obligation or debt that an individual or entity owes to another party, or the value of the resource depreciates over time. In Rich Dad Poor Dad, Kiyosaki defines a liability as something that takes money out of your pocket. So think of your finances like a simple balance sheet. On one side, we have assets, and on the other, we have liabilities. And then we have income and expenses, the key components that either build wealth or lead to financial stress. These four elements interact and define your financial success. Let's start with income. This is the money that flows into your pocket. For many people, income comes from their job, either through a salary or wages. Now, while having a steady income is important, it's what you do with that income that will make a difference. Kiyosaki talks about active income, money you earn by working, and passive income, which comes from investments or assets that generate money without constant effort. And the goal is to shift more of your income from active to passive over time. For now, we will just assume that your main source of income is a salary. But with a salary comes income tax. A portion of every dollar or pound or euro you earn goes to the taxman or woman. If you earn a large salary, then you will pay more tax. Your salary, big or small, generally defines what your standard of living will be. If you earn a large salary, then you will most likely want to stay in a nice house, drive a nice car, wear nice clothes, eat well, and maybe enjoy a local or international holiday every year. However, if you earn a low salary, chances are you will struggle to pay the bills, and money becomes a source of worry and stress. If you understand Rich Dad Poor Dad, then you will know there is a difference between income and salary. We want you to have a large income, regardless of what your salary is. Just stay with us. This will make sense in a few minutes. Back to the diagram. Once you have earned your salary and taxes are deducted, you have to decide what you are going to spend your money on. Just a note, I have changed the diagram slightly as this version makes more practical sense to me. I have grouped all expenses that don't put money back into your pocket as liabilities. Now, let's talk about expenses. These are the costs you incur on a day-to-day basis. Very often, a small portion will go towards a retirement annuity or a 401k. Of late, these company-forced programs are being phased out and the responsibility of your pension will fall on you. You will need to make the necessary arrangements with an investment company to invest those funds for your retirement. The rest of your salary will most likely be spent on the following: your mortgage or rent, a car and fuel or other transportation to get to and from work, food, entertainment, credit card expenses for day-to-day expenses, clothing, medical expenses, and insurance. There are many other expenses that we can table here, but let's leave the ones we have here as the main ones. All of these are considered your personal expenses. So if you look closely, you will see that most often your expenses will match your income and there is very little left over at the end of the month. Kiyosaki makes a strong point that if your expenses are greater than your income, you're living in a state of financial imbalance. Also, don't think that people with a big salary are wealthy. Very often, they will go broke in 2 or 3 months if something happens to that nice fat salary. The global financial crisis of 2008 should still be fresh in most people's memories, and many people rich and poor lost everything. The reality for most people is that when their salary increases, their spending also increases but on the wrong side of the equation. They buy a bigger house, nicer car, eat out more often, and the result is the same: no money left at the end of the month. The trick here is discipline. If you can manage your expenses and cut down on unnecessary spending, you'll have more money left to invest in assets. Kiyosaki emphasizes that you need to be cautious about accumulating liabilities because they can drain your wealth over time. Instead of purchasing things that you don't need, focus on acquiring assets that generate income and can potentially cover your liabilities. So how should you spend your money when you get that salary increase? Easy. You spend it on assets. According to Kiyosaki, assets are anything that puts money into your pocket. Just pause the video quickly and make a list of 5 asset classes that you are aware of. Welcome back. I bet that you quickly thought of 3 or 4 assets. This could be real estate, stocks, cash savings, or even a small business. If you listed your primary residence or car as an asset, then you are mistaken. The banks will tell you they are assets, but if you look carefully, you will note that money goes into those 2 entities and only comes out when you sell it. Remember the definition of an asset. It needs to put money into your pocket. But what other assets are there? And more specifically, how can you understand exactly which assets you can afford? You might not have the cash right now to purchase your own home. Never mind a second rental property. We will get to that in a minute. The key takeaway here is that true wealth is built when your assets generate more income than your expenses. The more assets you acquire, the greater your financial security becomes. Remember, assets puts money into your pocket. Think about it. If your rental properties or investments are paying your bills and funding your lifestyle, you're financially independent. Let's break down the simple assets we defined earlier and explain why they are assets. Firstly, savings. Savings in the form of a cash savings account is the simplest form of investment. Generally, the bank will pay you interest over a period of time, but this percent is often very low and below inflation. However, at the end of each month, the cash balance has either stayed the same or grown slightly. Secondly, retirement annuity or a 401k. This money is often invested directly in the stock market. Investing in stocks can be a powerful way to grow your wealth over time. It involves buying shares in companies with the hope that they grow and perform well over time, resulting in dividends and gains on the share price. Many people have made a lot of money in the stock market. Just think of George Soros and Warren Buffett. But stocks are considered risky. If you try to play the market by buying low and selling high, the chances are you will lose your money. The old adage is, time in the market, not timing the market. If you invest in stocks or stock portfolios, they will generally outperform cash over time. There are also tax benefits in investing in a 401k, so do your research properly and consult a financial advisor to provide you with professional advice. I am merely stating generally accepted facts, so please do not take this as financial advice. Thirdly, real estate. If you own a second property and rent it out, that rental income can be used to pay off the mortgage, and once the debt is paid, that rental income will keep flowing to you as long as there is a paying tenant in the property. See our other video on how to use compound interest to pay off your mortgage and start investing in real estate. The link is in the description. Fourthly, education. At first you might think this is a liability as you are paying for an education and not really getting anything tangible in return. But think about it for a minute. If you have a qualification, then you can apply for a higher paying job. That higher salary will increase your income, maybe not while you are studying, but within a year or 2 of completion, you should have some success. Just make sure you study something that gives you skills that the market is willing to pay for. Lastly, is your own business. You don't have to stop your job to start a small business. As long as it does not interfere with your day job, you should think of a side hustle that you could start that could generate some income, even if it is small at first. Who knows? It might grow, and the revenue in terms of profits might grow with it. For people who don't want to start a business from scratch, it is often best to purchase a franchise. However, do your homework, as often the seller is just looking to offload a dead horse onto the next sucker. Again, these are only a few asset classes we have highlighted, and if done correctly, your assets should continue to grow and add revenue to your income over time. Now I know that this might seem a very boring way to become wealthy. The secret here is to start today. In a year from now, your assets would have grown, whereas that nice new car will most likely be parked outside, needing a wash. The thrill and novelty would have worn off. That nice new house will be keeping you up at night, especially if you have a horrible boss. You want to leave your job, but you have a house to pay. Once you are in debt, the system will ensure that you stay in debt. always enticing you with something better, faster, shinier. Fight the urge to spend your money on liabilities and have the discipline to spend it on assets. Okay, so now that we understand the basics of income, expenses, assets, and liabilities, let's talk about how to practically apply these concepts. Here are a few actionable steps to get started. Firstly, track your income and expenses. Know exactly how much money is coming in and going out each month. This will help you see where you can cut back and save. Often paying off high-interest debt is a good start. Secondly, reduce liabilities. Look at your liabilities. Are you spending money on things that don't generate any income? Maybe it's time to reconsider that car payment or subscription. Thirdly, invest in assets. Start acquiring income-generating assets. Real estate, stocks, investing in your own education, or starting a small business can provide that long-term passive income. Lastly, mindset shift. Ultimately, it's about changing your mindset. Kiyosaki says, it's not how much money you make, but how much money you keep, and how hard it works for you. Educate yourself by reading books and watching videos like this. Rich Dad, Poor Dad is a top-selling book, and the principles shared have been proven over and over. So, there you have it, a quick dive into the income, expenses, assets, and liabilities framework from Rich Dad, Poor Dad. Remember, understanding these concepts can literally change the course of your financial life. It's about becoming more intentional with your money, building assets that work for you, and getting rid of liabilities that drain your wealth. If you enjoyed this video, give it a thumbs up, share it with friends, and don't forget to subscribe for more financial tips. Also, drop a comment below with any questions or topics you want me to cover next. Thanks for watching, and I'll see you in the next one.